Right. Thank you, Justine. So we want to welcome you all to this Corporate Strategy Masterclass on mergers and acquisitions. It is an honor to have with us here today Laurence Capron from INSEAD and Melissa Graebner from University of Illinois at Urbana-Champaign. My name is Katie Mogelson. I'm an assistant professor at London Business School, and I'll be moderating the session. Now, this is actually part of a larger series of masterclasses that the Corporate Strategy Interest Group has put together. For those of you who have not joined the prior sessions, I really encourage you to go online to our webpage, and we have these videos posted online so that you can view them at your leisure. The last session that we had was with Emily Feldman and Asim Call, and it was a fantastic session. So I encourage you to go online to see them. Today we're covering mergers and acquisitions, and I also want to highlight that we have two more upcoming for this academic year. We have resource allocation across businesses and countries with Heather Berry and Wenwan Zhao. That's scheduled for April 17th at 12 p.m. Eastern Time. And we also have a session on governance choices led by Gautam Ahuja and Harbir Singh. That's May 30th at 12 p.m. Eastern Time. So you can put these on your calendars. We encourage you to sign up and join those sessions. Now, these sessions are organized by the engagement officers for the Corporate Strategy Interest Group, Elisa Alvarez Garrido. I could not do this without her today's session. She has been really integral in helping put this session together. And we are really excited to have Laurence and Melissa join us today. So Laurence is a professor of strategy at INSEAD. She's an expert on M&As. She co-authored a book, Build, Borrow, or Buy, with Professor Will Mitchell. And then we also have Melissa Graebner, who is a professor of business administration at the University of Illinois. And she is also a co-editor at Strategic Entrepreneurship Journal. And her research includes corporate governance, entrepreneurship, mergers and acquisitions, and strategic decision-making. She uses fieldwork and case studies for engaging in this. So we have two leading experts on M&As. We're really excited to hear what they have to share with us today. Now, for this session, what we're going to do is we're going to have each panelist present for about 20 minutes. And then after they present, we're going to open it up for Q&A. Please feel free to use the Q&A posting at the bottom of your screen and write any questions that you may have. Often it takes a few minutes for the Q&A to get warmed up. So please, if you have any questions as you're going through the session, feel free to put it in the chat, and then we'll try to start from there to kick off the discussion. But we want it to be engaging and lively, so we will unmute you so that you can ask your questions directly to the panelist. So with that, we're going to go ahead and hand it off. So I'm going to hand it over to Laurence to go ahead and start her presentation.
Okay, hello everyone. Thanks, Katie, for the very kind introduction. I'm very pleased to join the masterclass today. Melissa and I will share our views on M&A, and which we hope you will find complementary. I will present my perspective on value creation in M&As, and Melissa will share her views on the process side of mergers and acquisitions. Before we start, we just would like to say that it's going to be very challenging, of course, with 20 minutes each to account for the entire rich body of knowledge produced on mergers and acquisitions from scholars across the field. And so here, Melissa and I, we have assembled a list of references, of reviews that will provide depth and breadth on the different topics we are going to cover. And of course, by far, this list is not exhaustive. When it comes to my perspectives on value creation in mergers and acquisition, I will focus on three main aspects. What do we know on M&A activity per se? What do we know on M&A and value creation? What the empirical findings we have? And then I will conclude by presenting a few theoretical views on M&A and value creation. So when it comes to M&A activity, empirical research has already done a lot. So we know quite a lot about M&A activity. We know that M&As are widely used by companies. We know that they occur in waves. They tend to cluster in time, space, country, and they also occur for a variety of economic and non-economic reasons. So when it comes to the use of M&As, we know that many companies resort to acquisitions. M&A deals are among the most important events in a company life cycle. They have a lot of effects on their activity, the scope of the firm, the performance. If you just look at the stock listed firm, the market for corporate control, research has shown, particularly focusing on the US listed firm, that about 90% of firms engage in at least one M&A, for example, during the period here of study, which was the 90s and 2000. And about 75% of them use frequently M&A to grow, about 8 deals during the 2 decades which was studied. Firms which tend to be younger, newly IPO firms, tend also to use a lot of M&As to grow and to scale up. And most of the time, going IPO is a way for firms to be able to do acquisitions. So a recent study done by Ashley Arikan and colleagues show that about 70% of the newly IPO firms have done an M&A by the end of the second year following the IPO. And when they are used effectively, we know that M&As can be a very powerful tool for growth and innovation. And they can be, of course, a very important way to complement non-organic growth. And usually when we teach, we often refer to the successful cases like the tech company or the consumer goods company who have been using M&As effectively. So an example would be, for instance, L'Oréal, number 1 in the world in the cosmetic industry. And L'Oréal has been able to assemble a very effective portfolio of distinctive brands through an effective acquisition strategy. So out of the 40 brands of L'Oréal today, only 2 were grown organically. The rest of the brands were acquired. It doesn't mean that L'Oréal only makes acquisition. L'Oréal is very good at building organic growth on the top of what they buy. If you look at, for example, the professional service firm, they have been using a lot of M&As. For example, the big 4 accounting firms trying to make inroads in the strategic consulting area by making a lot of acquisitions. And if you look, for example, at the MBB, recently they have been buying a lot of firms either to ramp up their digital skill and more recently their sustainability consulting capabilities. So we know that when they are used properly, M&As can really be a very effective way to innovate and to buy distant or disruptive capabilities. When it comes to when they happen, what is very fascinating about M&As, which is different from internal growth or joint ventures or more licensing, more discrete focus agreement, that they tend to occur in waves. So they tend to cluster in time, they cluster by industry, and they also cluster in space. So it has been shown that M&As usually, the M&A waves, are highly correlated with periods of economic expansion and high stock market valuations. As of today, we have identified 7 merger waves, 5 that took place in the last century and 2 post-2000. So what you can see, if you look at the recent cycles, what you can see that even if we have cyclicality, even during downturn, we still witness a robust volume of M&A activity. So, for instance, in 2021, post-pandemic, it was the highest level of M&A with about 6 trillion of M&A deals. And last year, because of the challenging macro environment, the total value of the M&A deal had fallen by 37%, but you can see that it's still a 3.7 trillion of M&A deals. So it's still a huge amount of M&A activity. We also know that they tend to cluster by industry. So at some point, an industry got hit by a wave of consolidation and M&A, and we will witness a lot of M&A within a very relatively short time span. What we also know is that M&A also tend to increase in country with high GDP, developed financial markets, and characterized by M&A friendly institution. So for instance, here what you can see on this diagram that there is a negative correlation between the M&A activity and the extent to which the shareholder rights are strictly protected. So even among countries with high GDP, we will see variation. For instance, you can see in this diagram that the US activity represents about 8% of the GDP. In Germany, it's about 3% of the GDP. And you can see here an interesting correlation with the extent to which the employment protection is high or is much lower. And so usually the high employment protection country have fewer takeovers. And likewise, country with high shareholder protection right will have more takeovers. And we also know that M&A can occur for a variety of economic and non-economic reasons, and the drivers of M&A are very complex. So M&A can happen for kind of bad reasons or not for creating long-term value for the company. They can, for example, be driven by self-serving managerial reasons. So we have a lot of studies that have documented that they can be done for empire building, for ego, for hubris reason. They can also be done by executives who pursue the wrong incentives. For example, they want to buy growth at any cost. And they can also be driven by social pressures, by some managerial herding behavior, or by reason linked, for example, to commitment to the M&A process. So there are a lot of reasons for witnessing M&As which are not necessarily driven by value creation motives. So a recent example being, for example, the Twitter acquisition, where one of the goals is to help or to save humanity. What we focus as strategy scholar most of the time is to try to understand how we can have a value creation out of an acquisition. And particularly, we focus more on the strategic side of the synergy. Whether an acquisition will help to turn around the target, will help to yield cost or revenue or asset synergy, or will help to, for example, scale up an early winner. And there's also a part of the synergy which are more financial in nature. And increasingly, we have also been looking at the financial synergies, particularly in the context of the private equity firm making acquisition. But we can start to understand from this diagram that it can be very difficult to create value, right? I mean, we can see that in the first place, some deals are not made to create value. This is the left side. And on the right side, even if the goals of an acquisition is to create long-term value, it's very hard to execute. It's very hard, for example, to assess, to price synergies, and it's even harder to deliver the synergy. And of course, as a result, we have been witnessing a lot of value-destroying deals. And some of these deals, for example, have been very well covered by the press. The larger the deal, the higher the value destruction, the higher the risk, and the higher the coverage of these deals. So we can see that across industry, we will witness value-destroying deals. Beyond these high-profile value-destroying deal company examples, we can wonder what we really know about performance of M&As on large-scale sample. So in the second part of my presentation, I'm going to report what the empirical research has produced in terms of result when it comes to performance of acquisition. Some studies, some reviews have pointed out the inconsistent findings across performance studies. It's true to some extent, but it is also fair to say that after decades of research on M&A performance, there is an emerging consensus on the average effects of M&A on the performance of the merging firms. So I will first present what we know on the short-term effect, then I'll turn to the long-term effect, and then I will focus on what can drive the variance of performance. So we know by now, after decades of research, that on average, it is bad news for the shareholder of the acquirer to announce an acquisition. And last month, we had very interesting presentation on divestiture. And Emily Feldman was mentioning that, for example, for divestiture, the average announcement effect would be in the range of +2, +3%, right? And we know that for acquisition, on average, it's bad news for the acquired shareholder. And event study, particularly in finance, have documented this result. And so here, I think we are all familiar with the most popular approach to evaluate M&A since the 70s, which is the event study, which is the announcement effect, and how the investor will anticipate the M&A success when an acquisition is announced over and above a market benchmark. Some limitations have been discussed at length, of course, when it comes to the event study and the investor anticipation, that the fact that we may not have the full information at the announcement, that the market will readjust, and also there have been plenty of discussion about the potential biases of the event studies. But again, across many samples, the key findings, the consensus which emerged, that on average, the bidder shareholders earn 0 or even negative return at the M&A announcement, that the target shareholders will capture the bulk of the returns. And when it comes to the combined value, we may see a slightly positive value creation. So typically here, what we will see that when there is an announcement, if, for example, you take this announcement of the Microsoft announcing the acquisition of LinkedIn, you will see that usually the Microsoft share here, the red line, we kind of remain stable or a slight drop. And then at the announcement, the LinkedIn, the target, we will see a spike of the value of the target, plus an appreciation during what we call the run-up period before the announcement. And so is this example, why this example is typical? Because when we review, again, thousands of studies in finance over thousands of deals, this is the average effect that we find. We will find here that the target effect, again, we will see here an appreciation. The average return for the target is going to be positive and significant in all sample over both the run-up and the announcement period. We will see that on average, the cumulative abnormal return for the acquirer is going to be close to 0 for the overall sample. And overall, here in this review, the overall combined value was about at 1.8%. Okay. Here, what is interesting in this diagram, you see some nuances that for the target appreciation, it was even higher when the bidder was public, and it was a bit lower when the bidder was private. And you can see for the bidder appreciation that on average it's 0. It was negative and significant for when the target was public, and it was more positive when the target was private. And again, more competition and more likely to overbid when the public is target versus when the target, is private. Okay. And then And then when it comes to the long-term performance, because of course we could argue that abnormal return in event studies just an announcement effect. What about the long-term studies? So it turned out that finance scholars have kind of tried to look at the long-run stock performance of the acquisition, with some limitation because of course it's become more complicated to isolate the M&A effect from the other effect that could influence the stock price of a firm. But overall, what was found that the long-term returns accruing to the acquired shareholder were also found to be negative or not different from 0. There's also an interesting study which, in addition to the stock market return, I've looked at the long-term accounting performance. And here we have an influential review, which was done by King and colleagues. And again, they find insignificant or negative long-run acquire market or accounting return. So at the very least, M&A deals do not increase the acquired firm performance on average. We could also look at other aspects of the performance, and we have strategy scholars which have looked at different facets of the performance, such as the efficiency, the impact on market power, the resource acquisition, redeployment, the innovation outcome, or other long-term firms outcome. And what is an example here would be, for example, the work which has been done on the extent to which an acquisition will help innovation of the firms. And again, here we talk about an average effect when it comes to innovation outcome. But there was a very nice study, for example, done by Kapoor and Lim, and they look at the number of patents per inventor in a sample of acquired software company versus a match sample of non-acquired firm. And again, here you can see on average, there's a shock with a decreased productivity in innovation for the firm which get acquired. What, of course, this is an average effect, and what is important for us is to try to understand the variation of what drives the variation of performance, because even if on average it does not create value, what is interesting for us, for strategy scholar, is really to understand what does it take for a firm to be in this kind of value creating bucket and to avoid to be in this value destroying group here. And so finance has tried to tackle this by looking at different financial items. So here you have a list. I put a reference for a review, but overall the worst combination is really public firm, large deal, public target, payment in stock. So they look at all the element of the bidding process of the financial aspect that could drive the variance in the performance. In strategy, we have been focusing a lot on this notion of relatedness, some form of relatedness, industry, resource relatedness, context relatedness, experience relatedness, so that to some extent, the more related we are between the target and the acquirer, the more likely we should be able to increase the performance. And with a kind of cap that at some point, we might see a kind of inverted U-shape. There was an interesting piece here from G. Barney that will consider this relatedness hypothesis. I think that was a very interesting insight, that relatedness is not sufficient to ensure return to bidding firm shareholder. At some point, there need to be some degree of uniqueness in terms of either the private information, but more importantly, some unique resource fit between the target and the acquirer, so that the synergy are not bid away by the multiple bidders. And so this notion of unique fit and unique resource combination to some extent shifted our focus from the kind of the dyadic resource combination to really try to understand the distribution of capabilities and resource combination among the different bidders. And last piece on the empirical part of M&A performance, that there's also a set of studies which have looked at M&A programs, because a third of the M&A do not take place independently. They are part of a sequence of an M&A program. And what is interesting here is that, again, what has been found that the performance of serial acquirer is on average declining from deal to deal, both at the firm level and at the CEO level. And we have some colleagues in strategy who have investigated the motivating factors, such as the scope, the pace of the program, the experience, and the learning mechanism. So this is more or less the consensus about what we know about the long-term and short-term effect. So I think there's a consensus on the average effect. There's still a lot to do when it comes to the sources, the variation in the performance and the sources of value creation. So for my last part, I'm going to turn to the theoretical views on M&As. And again, those views should also help us to further nurture our research agenda on empirical performance of M&As. And so I will present 4 perspectives. And again, they are not mutually exclusive. We can see different sources of value creation coexisting in mergers and acquisition. So the first view, I will start with the well-known agency view, the market for corporate control, where M&As are seen as a way to discipline the manager of firms which are kind of mismanaged. So this view has been dominant in finance in the 70s. As we move to the 70s, 80s, the dominant view was really, particularly in our field and in IO, was really M&A as a way to dominate an industry, to offset market forces, to help the firm to be on the efficiency frontiers, and a lot of interesting work on efficiency versus market power when it comes to acquisition. As we move to the 70s, 80s, and 90s, I think, and the field in strategy has shifted from an industry level of analysis to a resource level of analysis, and really viewing M&As as a way of acquiring resources which are subject to market failure, and as a way also to strategize on the market for resources. And last view, which is, I think, the most recent view, and again, it's related to the former view, it's really the dynamic capability and the reconfiguration view, where M&A is really viewed as a way to reconfigure resources and businesses to reach a fit with the dynamic environment. So I will just for a few minutes zoom in the reconfiguration view. And so with Samina Karim a few years ago, we assembled a virtual issue on this perspective of reconfiguration that we define as a part of a proactive process by which firms are going to change their resource base to survive in their competitive environment by adding, redeploying, recombining, and divesting resources, businesses, product lines. And so if we think of the theoretical roots of this view, I think that we could refer to at least three related complementary views. The first one, the obvious one, is of course the resource-based view and this notion of excess resources that needs to be redeployed. The second view would be more embedded in this notion of intertemporal economy of scope, the need to react to permanent changes and to align with the changes in the environment by retrenching, by replicating, by redeploying and recombining resources. And the last piece would be the dynamic capability view, where reconfiguration view has been referred as the third leg of dynamic capabilities in addition to sensing and sizing. So with this view and multiple ways of thinking of reconfiguration, multiple words and activities have been referred to. And in this view, acquisitions and divestitures kind of go go together, right? Acquisition are treated as a way of adding and redeploying and recombining resources, and divestiture as a way to remove obsolete resources, to free up resources and to go. It goes in kind of in cycles here. And when we think of M&A induced reconfiguration, they occur, it occurs at multiple levels, from business unit to line of product to resources to employees, human capital. And as we move down, of course, it's increasingly difficult to collect data, empirical data on these processes of reconfiguration. And what is complex with reconfiguration, and it's another layer of complexity, that reconfiguration of resources which are bought can take place at the deal level within the acquired unit. They can take place across deals, across target in the context of a program of M&As. And of course, they can also take place at the portfolio level of the firm, and they can be, to some extent, recombined and redeployed with internal units and with JV units and so on. And so this is here the three layers of reconfiguration, which I think is important. And I think what is important, at least for people working on reconfiguration, to be mindful of this multi-mode reconfiguration and trying to think of that as important component of strategic renewal, not only to make progress on the research side, but also if we want to be and remain relevant for practitioners, company, when they think of growth and innovation and renewal, they look at the different pieces together. Just example of if you, for example, look at the annual report of Cisco, they refer to their build, buy, partner, invest, and co-develop model. You know, and in the buy, you can notice that they refer to acquiring or divesting depending on the goals. And just on this on this portfolio approach, a few years ago, I did a review and started to review the different papers who look across the modes. And I found fascinating result that acquisition, when they get complemented with other modes, whether it's alliances and internal development, it tend to increase the long-term performance, the balance across the mode. And different studies here, different scholars have found very interesting variation in the portfolio, which raise complementary and trade-offs in terms of exploitation versus exploration, in terms of asymmetric experience spillover across the mode, or this notion of concurrent learning processes to make sure that firm can assemble the portfolio of modes of change and reconfiguration. Just to close here, a few thoughts on M&A and value creation for researchers looking forward. I think that we still have a lot to do on M&A and creating value. We have to go beyond short-term versus long-term or stock market versus accounting data. I think the question is, what is the counterfactuals when you make an acquisition? You know, is it the risk of not surviving, the growth sustainability, the value to whom? To owner shareholders, the value to the firm stakeholders, the total value, firm value and value to society. When it comes to M&A and strategizing, I've seen very interesting work, for example, really measuring in a very fine gray the post-acquisition resource redeployment. For example, looking at really the transfer of employees across all these units. I've seen work in the innovation literature, looking at the startup incumbent acquisition and this notion of preempting resources in the strategic factor market with this notion of killer acquisition. There's also been interesting view on how we can think of synergy, not just inside synergy, but also relational synergy and also non-market stakeholder synergy. And finally, when it came to this portfolio, this multi-mode reconfiguration approach, I think we still have a lot to study about how the composition and the balance of the portfolio, how much variety versus specialization, and how we can build up the reconfiguration capability and the extent to which they are fungible across mode. So at this stage, I think that we have done a lot in terms of empirical evidence and theoretical view on M&A, but it's still at a fairly high and aggregate level of analysis. I think it's also important to look at the process level that explains a big part of the success or failure in M&As. So now I will pass the presentation over to Melissa. Thank you.
Thank you, Laurence. That was an excellent, very informative and comprehensive overview of the research on M&A. And I will be building on that. The point that you ended on, which was talking about reconfiguration and redeployment, is a very nice segue into talking about process perspectives in mergers and acquisitions. So I think Laurence established very well, mergers and acquisitions are ubiquitous, but they're also very challenging. It's hard to get value out of them. And so a process perspective can be very helpful in understanding why and thinking about some of the complexities that are underlying these challenges. My controls here. So let me first talk about what I mean by a process perspective. A process perspective looks at how and why things emerge, develop, grow, or terminate over time. And it also looks at interactions of many different parties that are in different functions at different levels of the organization. And these two themes of emergence and multiple actors are very useful for understanding M&A because they direct us to the multiplicity of actors that are involved, the way that the phenomenon emerges and evolves, and also the ongoing influence of contextual features, which are all things that I'm going to briefly touch on. I know there have already been some questions posted in the Q&A and also in the chat, and we will leave some time for those at the end. Please do feel free to continue to pose questions, including anything related to the great material that Laurence presented. So I'm going to focus on three different insights we can get from applying a process perspective to M&A. The first is understanding that mergers and acquisitions are not unilateral, they're dyadic transactions. The second is that implementation is very important. Post-merger integration is what creates value for most M&A. And then the third is how particular contextual features, such as industry, can influence the way that M&A unfolds. So the first insight that we get from a process perspective is that we need a fundamentally different metaphor for understanding what mergers and acquisitions are. Much of the early research viewed M&A essentially as a shopping trip where the buyer picks out the company they want to buy, which is immediately available to them, pays the price, and the deal is done. Even the language that we use, the buyer is related to the verb to buy, but there's no verb that corresponds to target. So I actually prefer the terminology of seller because the acquired firm actually can be very active in this process. And so rather than a shopping trip, a better metaphor is a courtship where both of the parties are actively involved. So let me show you some evidence to support this. One recent study looked at acquisitions of publicly traded firms. So these are large transactions in the US over a 20-year period. And they looked at the filings to the SEC and found that actually only in 41%, so well less than half of cases, is the acquiring firm initiating the deal negotiations. In the rest of the cases, there's either mutual discussion or the target firm is initiating the discussions. Another way to look at this is how many bidders are involved. To the extent that there are lots of different bidders and there's an auction, that may disempower the target from being able to choose their buyer. But it turns out that even in acquisitions of large public companies where we might expect to have multiple bidders, about half of the deals involve negotiation with only a single bidder. So what this means is that the selling firm signs a confidentiality agreement with only one bidder and receives only a single bid. So the selling firm has a lot of influence on who the buyer will be and whether a transaction will happen. And those examples are from public firms. We can expect that auctions are even less frequent in acquisitions of private firms. And Laurence has done some excellent research on this. The idea is that information asymmetry in the market for private firms can discourage bidders, and there isn't the same pressure from shareholders in the public markets. So the sellers of private firms may have even more influence over whether a transaction happens and who the buyer is. So now that we understand how important sellers are, you can see that it's important for the buyer to understand the seller's perspective if they want to get an acquisition done. First, they have to understand, is the timing right for the target to sell? There are particular windows of opportunity when there are transitions within the business or personal issues in the top management team that make them open to considering a sale of the firm. The second thing that the buyer needs to understand is what characteristics is the seller looking for? And it turns out that price is only one consideration. When people are looking to sell a firm, they also care about strategic fit between the two firms. Are there complementary resources that the buyer can offer? They also care about organizational fit. Is there cultural similarity, trust? Do they feel that they're being respected by the buyer? And so in one example from my own research, we had an entrepreneur that said we had 4 offers on the table. One was more financially attractive to us, but we didn't like the company. So they didn't optimize on price. They considered other factors that were important to them subjectively. Social relationships are, because of this, very important for deal negotiations. And trust turns out to be a particularly prominent attribute that sellers look for. Trust can form at multiple levels. It can be between individual CEOs. It can be at the organizational level, so the companies may have some prior relationship like an alliance. It can also be influenced by national attributes. So an example at the individual level is a recent transaction that was a very big merger that actually created the 4th largest automaker in the world. And these 2 CEOs had been friends for a decade, and this came up in much of the media coverage of this event, that there was a strong personal rapport, they had shared hobbies, and that facilitated the deal happening, even for such a large transaction. We also know that nationality matters. There are certain countries that tend to trust individuals from other countries more, and when there's bilateral trust, that tends to increase the deal completion rates. A process perspective also helps us understand that social relationships aren't just a variable that influences M&A, but actually the process of M&A influences social relationships. And so in some of my own work, I found that the process of negotiating an acquisition led to trust asymmetries, where the acquired firm leaders trusted the buyer much more than the reverse, and that had important consequences for the outcomes of the acquisition. So we can look at this as a recursive process where there's some social relationships at the start, and then they get modified during the acquisition process in ways that influence outcomes. The second insight we can get from a process perspective is the importance of post-merger integration. And the idea that value creation happens after deal close. It's an ongoing discovery process. And ways that value is created include knowledge sharing, resource reconfiguration, et cetera. Post-merger integration used to be thought of as a linear process, perhaps even a binary process that an acquired company is either integrated or not. But increasingly, we are looking at this as a more multifaceted, dynamic process that can be unpredictable. It has many different sub-processes that influence each other. There's complexity, ambiguity, and contradictions. Because of the complexity of the phenomenon, there is a vast and fairly fragmented literature on post-merger integration, which I will just very briefly highlight here some of the dimensions that have been examined. So one is looking at the degree of interaction, communication, and coordination between the parties. And the preponderance of the evidence suggests that having more interaction, more communication improves performance. There's another literature that looks at alignment and standardization of practices and integration of specific functions. So this goes beyond communicating and coordinating to actually combining and standardizing. Here, the evidence is mostly positive, but somewhat mixed in terms of whether more of this type of integration is better. There is also a stream of literature that looks at structural integration, which is usually defined as having a shared P&L. So it's a binary 0-1 measure of the level of integration. And here there seems to be trade-offs. So there can be some slowing of new product introduction and the patenting activity of acquired inventors, but it can increase leveraging of the knowledge of the target company. So it's a complex trade-off. And then finally, there's a stream of research looking at autonomy, which originally was felt to be the opposite of structural integration. But there's some intriguing evidence that actually these are two different dimensions, and the correlation is only about 0.2 between them. It seems that preserving autonomy for the acquired firm is generally positive in terms of announcement returns and some other performance measures, but on the other hand, may reduce knowledge transfer. So not a lot of clear-cut lessons or recommendations other than the importance of communication. To add to that complexity, there are a number of variables that shape post-merger integration, but in counterintuitive, unexpected ways, and sometimes ways that change over time. Just a few examples: having social and cultural differences generally seems to cause underperformance, but there is some evidence that it can actually increase knowledge transfer. We know that post-merger integration can lead to identity threats, which are problematic for target employees. But on the other hand, there's evidence that having an identity threat spurs acquire managers to take proactive steps to identify synergies. So to understand post-merger integration, we really need a more fine-grained longitudinal perspective, because these effects are nonlinear and they're emergent and they change over time. Finally, the third lesson that we can take about M&A from a process perspective is how context matters. And there are many dimensions of context that are relevant here, but I'm going to focus specifically on industry and highlight two different research streams that look at M&A activity in different types of industry contexts. And the effect of context stems from several different factors. One is that the source of value in the M&A event is different depending on the particular industry context, whether it's acquiring customers, acquiring employees with particular capabilities, or acquiring technology, intellectual property, et cetera. The pace of industry change is also different across contexts, and the attributes of the people that are involved. So inventors, as a general rule, may be very different in terms of what makes them productive than client service professionals. So one example that has received some attention is professional service firms. So these are accounting firms, management consultancies, advertising agencies, law firms, et cetera. All very active in M&A activity in recent years. In this type of merger, a lot of the value is in the people that are being combined, the knowledge and their relationships, both with each other and with the clients. In professional service firms, culture, status, and maintaining particular professional standards are highly prized. This means that the challenges for mergers of professional service firms are culture clash, which can inhibit knowledge sharing, clash of values, which can lead to dissatisfaction and turnover, and also competitive conflicts that can lead to client loss. So the clients that the buyer hoped to get may actually walk out the door because of competitive conflicts. On the other hand, in technology M&A, which would be information technology, biotech, et cetera, we have a different set of goals. Larger firms are often acquiring startups for their innovative capabilities, and speed to market is a key success factor. What this means is that you have a different set of challenges. Integration into a large organization can actually dampen innovation and entrepreneurship. Bureaucracy can slow down speed to market. Post-merger integration can trigger high turnover, and it seems that the most qualified, most entrepreneurial employees may be the first to leave. So just to recap, some key insights from a process perspective, and then we'll get to your questions. M&A transactions are not unilateral. We need to understand both parties and how they interact over time. Value creation is not instantaneous. It emerges through a complex, unpredictable, multidimensional process. And finally, M&A processes are shaped by contextual features and vary across industries. So universal solutions are very elusive and may not exist. So with that, I will close and we can move to your questions.
Okay, wonderful. These were two fantastic presentations, and we're going to now open it up to questions. Rahul, are you able to go ahead and ask your question?
Yes, I hope you can hear me.
Yes.
Okay, I'm tuning in from India. I have a question for both Professor Capron and Professor Melissa. The first one is to Professor Capron. You spoke about the price of companies varying, when you undergo a merger. So essentially, the acquirer's price comes down and the target company's price goes up, as was shown by your Microsoft LinkedIn graph. But won't this generally depend upon the strength and the business image of the acquiring company?
Yeah, so for sure. I mean, if again, it's an average effect. So what you see that if an acquirer has a very strong M&A record, when this acquirer does announce an acquisition, then you will see an appreciation of the share price of the acquirer, because the market will anticipate that the acquirer knows what he or she is doing, and most likely it will be properly integrated because the firm has already built up some acquisition capabilities. So yes, you're right. The image and the record will impact the reaction of the market. Yeah.
Okay, thank you. My second question is to Professor Graebner. You spoke about how you consider M&As are more of a courtship as compared to a shopping cart. That was a really interesting comparison. But this equality of this dyadic transactions between two firms or one and many firms, getting acquired, won't this equality kind of depend upon the target firm's ability to swing or refuse the deal?
Yeah, so I think that's a very good point. And the target firm will certainly have more discretion to the extent that they're not struggling, so that they have the means to remain independent. Sometimes with companies that are in bad financial condition, they don't have the opportunity to be able to turn down buyers. There are also issues about corporate governance and how much influence the CEO has versus shareholders who may be interested in getting the highest possible price. So I agree that there's certainly some variance there.
Okay, thank you.
Okay, great. Let's move on to Ruzana. Yes, I am.
Hello, can you hear me?
Yes. Yeah.
Perfect. Good afternoon, professors. Thank you very much for this presentation. I am a practitioner in the field, and just looking at some of the comments that you've made, question around overlaying, resource-based view and configuration-based view, and intercepting that with PMI. And I guess the question is, from my perspective, is I'm observing an industry that, acquirers are more and more looking to do M&A for acquiring resources, including talent in some of the industries. That's a big gap. And as far as their reconfiguration, again, with the industry lines blurring, it seems that companies are also reconfiguring as far as their capabilities and how they go to market. So in terms of the PMI, I was curious, is there a point of view what can firms do to prepare ahead of the deal in order to be able to extract value post-deal? And does that preparation differ depending on kind of resource versus reconfiguration-based view? If this at all makes sense. Thank you.
I'll provide a brief answer, and then I'll be interested to hear what Laurence says. But this is not exactly preparation, but there is a growing body of evidence that more value is created in terms of reconfiguring, recombining assets, sharing knowledge, if some of the acquired leaders are in managerial positions. So if it's not just a matter of the acquired taking over, but if some of the people from the acquired company end up in positions where they oversee aspects of the combined company, that tends to produce more opportunities for synergy between the two firms.
Understood. Thank you very much.
Yeah, I think to avoid the sequential process where the CEO and the advisors make the deal and then they throw the baby over the wall to the operational people. So to as much as it's possible to involve the operational people in charge of managing the resources during the due diligence, because it's also making sure that you can map out the different resources and which one are going to be kept, reconfigure, redeploy, or spun off.
So it sounds like planning starts at diligence, and that's kind of the careful moment.
Yeah, due diligence should just be narrowed down to financial items.
Appreciate that. Thank you very much.
Okay, so I believe we have time for one more question. I see that there's a question from Susan Perkins on the corporate governance implications of M&As. So basically her question in the chat is, can you please discuss the implications of M&As when the target stays on top to manage the firm?
Yeah, and I think it's interesting. She refers to the Daimler-Chrysler deal. And again, if we link back to the PMI and the influential work from Asper Slag and Jamieson about where you are, whether you have to shoot for absorption, symbiosis, or preservation, I think that when there's a need for turning around a firm, to some extent there is no value or less value to maintain the top management team of the acquired firm if the goal is to turn it around. And so it's not necessarily to have a completely process of equality, or it's really about what needs to be done. And if it's about, turning around, usually there is not so much value to keep at least the entire executive team. When it's about knowledge sourcing of new capabilities, distant capabilities, it's very important, of course, to keep the key executive and the key talent from the target. So there's a lot of contingency when it comes with what are the best practices in terms of keeping the top executive or not. Same for board membership. It's not necessarily a 50-50. You really need to go with the needs, the reconfiguration needs and what needs to be done. Yeah, Melissa, if you want to comment on that.
No, I think that was very well covered. Just one comment on the Daimler deal in particular. Their other problem was that the CEO of Daimler admitted to lying about his intentions to treat the deal as a merger of equals. So I suggest buyers should not do that.
All right. Well, this has been fantastic. I want to just thank you both for joining us on this session. Your presentations covered a lot of content. It was very rich and complimentary, and we really appreciate you taking your time out of your busy schedule to lead this masterclass. So thank you so much. And with that, we'll be in touch. So please, I encourage all of you to join the future master classes. But thank you both.
Thank you.
Thank you so much.